It didn't happen all at once. There was no single day, no breaking news alert, no moment where everything just snapped. Instead, it started quietly, almost invisibly. A house sat on the market a little longer than expected. Then another. Then 10 more. And no one panicked. Because at first, it felt normal. For decades, the housing market had trained people to believe in one simple truth. Homes always sell. Maybe not instantly. Maybe not at the price you want. But eventually, someone shows up. A buyer. An offer. A deal. That belief wasn't just optimism. It was the foundation of trillions of dollars in decisions. But what happens when that assumption breaks? In early 2026, something strange began to spread across multiple cities. Listings piled up. Open houses stayed quiet. Agents started using a phrase they hadn't needed in years. Low activity. At first, sellers blamed pricing. Maybe it's too high. So they adjusted. 5% down. Then 10. Still nothing. Then came the second wave of explanations. Interest rates are the problem. And yes, rates had risen. But here's the thing. Housing markets had survived high rates before. In the 1980s, mortgage rates were far higher than anything seen in recent years. And yet, homes still sold. So this felt different. Subtler. More dangerous. Because it wasn't just about affordability. It was about liquidity. Liquidity is a simple idea. It means how easily something can be turned into cash. Stocks highly liquid. You can sell in seconds. Real estate. Not so simple. But historically, it was reliably liquid. You could count on it. Plan around it. Build wealth with it. Until now. Because in these cities, something changed. Not prices. Not supply. Not even demand, at least not in the traditional sense. What disappeared was the buyer's urgency. Think about that for a moment. For years, buyers were conditioned to act fast. If you didn't make an offer today, someone else would tomorrow. If you hesitated, you lost. That pressure created momentum. Momentum created transactions. Transactions created confidence. But by 2026, that entire cycle began to unwind. Buyers slowed down. Then they paused. Then they stopped showing up altogether. And when buyers disappear, even temporarily, the entire system begins to seize. In cities like Phoenix, Austin, Tampa, inventory surged. But not because of overbuilding. Because of failed expectations. Sellers expected offers. Offers didn't come. Listings stayed active. Days on market stretched from weeks to months. And something subtle but critical began to happen inside the minds of sellers. Doubt. What if it doesn't sell? That question had been unthinkable just a few years earlier. Now it was unavoidable. Because the data told a story no one wanted to admit. Transaction volume was collapsing. Not prices yet, but activity. And in real estate, activity is everything. You can survive falling prices. You can adjust expectations. But when transactions stop, the market doesn't decline. It freezes. And a frozen market is far more dangerous than a crashing one. Because crashes are visible. They force action. They create urgency. But a freeze. It creates paralysis. Sellers wait. Buyers wait. Agents wait. Lenders hesitate. And the entire system enters a kind of suspended animation. This is what economists call a liquidity crisis. But on the ground, it feels like something else. Silence. Open houses with no visitors. Listing photos collecting dust online. Price reductions that go unnoticed. And behind the scenes, something even more important begins to shift. Expectations. For years, homeowners believed their property was a form of security, a fallback plan, a reliable asset. Need cash. Sell the house. Relocate. Sell the house. Upgrade. Sell the house. But what if you can't? That question doesn't just affect sellers. It ripples outward, into banks, into investors, into the broader economy. Because housing isn't just about shelter. It's about leverage, confidence, movement. And when homes stop selling, people stop moving. Job relocations get delayed. Life decisions get postponed. Risk-taking disappears. And slowly, quietly, the economy begins to stiffen. This is how a liquidity crisis spreads. Not with panic, but with hesitation. And hesitation is contagious. In past cycles, downturns were driven by clear triggers. Overbuilding, speculation, credit bubbles. But this time, the trigger was psychological. Buyers looked at the market and decided to wait. Wait for better prices. Wait for lower rates. Wait for clarity. And individually, that decision made sense. But collectively, it created a vacuum. Because when everyone waits, nothing happens. And when nothing happens in housing, everything else starts to slow down. This wasn't just a market shift. It was a behavioral shift, a repricing of risk, a recalibration of expectations, and most importantly, a breakdown of trust in the system's most basic promise, that homes will always sell. But now, in certain cities, they were. And that realization, quiet at first, was about to become impossible to ignore. Because what started as a slowdown was turning into something far more structural. A market where liquidity wasn't just reduced, it was disappearing. And once liquidity disappears, getting it back is never easy. So the question is, was this just a temporary pause, or the beginning of something much bigger? At first, it looked like hesitation. Nothing unusual. Buyers stepping back, taking their time, running the numbers again. But then something shifted. Not in the market, but in the mindset. Because buyers weren't just delaying decisions anymore. They were opting out entirely. And that distinction matters. A delay can be reversed. Opting out is something else. To understand why this happened, you have to go back a few years. Back to a time when the housing market felt unstoppable. In the early 2020s, buying a home wasn't just a financial decision. It was a race. Listings would go live in the morning and be gone by the afternoon. Offers came in waves, sometimes 10, sometimes 20, all competing, all escalating. Buyers waived inspections. They waived contingencies. Some even offered above asking price without ever stepping inside. Why? Because they believed something fundamental. If they didn't buy now, they might never be able to. That belief created urgency. Urgency created competition. Competition pushed prices higher. And for a while, it worked. But markets don't forget behavior. They store it. They respond to it. And eventually, they correct it. By 2025, the environment had changed. Not dramatically at first. Just enough to be noticed. Interest rates rose. Monthly payments climbed. Affordability tightened. And suddenly, the math didn't feel as comfortable anymore. A home that once seemed manageable now felt heavy. Buyers noticed, but they didn't panic. Not yet, because they had something new. Options. Inventory began to increase. Not explosively, but steadily. More listings meant less pressure. Less pressure meant more time. And more time changes behavior. When buyers feel rushed, they act emotionally. When they feel patient, they become analytical. They compare. They question. They hesitate. And hesitation is where momentum begins to break. Because momentum in housing isn't driven by logic. It's driven by fear of missing out. Once that fear disappears, it's replaced by something far more powerful. The fear of making a mistake. And in 2026, that fear took over. Buyers started asking different questions. Not how fast can I buy, but should I buy at all? They looked at prices and saw uncertainty. They looked at interest rates and saw risk. They looked at the economy and saw instability. And for the first time in years, buying a home didn't feel like a safe move. It felt like a gamble. That psychological shift was critical. Because housing markets depend on confidence. Not just the ability to buy, but the willingness. And once willingness fades, transactions follow. But there was another layer to this story. One that didn't show up in headlines. Investors. For years, investors had been a silent force in the housing market. Buying properties not to live in, but to hold, to rent, to flip. In some cities, they made up a significant portion of demand. And unlike traditional buyers, investors are driven by numbers, returns, cash flow, exit strategies. When those numbers stop working, they don't hesitate. They leave. And that's exactly what began to happen. Rising interest rates cut into profits. Higher prices reduced upside. Rental growth slowed. The equation no longer made sense. So investors pulled back. Quietly, quickly, and when they did, they took a massive layer of demand with them. At the same time, something else was happening. Sellers weren't adjusting, at least not fast enough, because they were anchored to the past, to prices from a year ago, to offers they could have received, to a version of the market that no longer existed. So they held firm. They listed high, waited, reduced slowly. But buyers weren't responding, because from their perspective, prices still felt disconnected from reality. And this created a standoff. Sellers unwilling to drop. Buyers unwilling to step in. A gap. And in that gap, liquidity disappeared. Because markets only function when both sides agree, even loosely, on value. Without that agreement, transactions stall. And when transactions stall, data becomes unreliable. Comparable sales become outdated. Pricing becomes guesswork. Uncertainty increases. And uncertainty pushes even more buyers away. It's a feedback loop. Fewer buyers, fewer sales. Fewer sales, right arrow, more uncertainty. More uncertainty, right arrow, even fewer buyers. And once that loop starts, it's difficult to stop. Because no one wants to be the first to act. Not the buyer. Not the seller. Everyone waits. And waiting is the enemy of liquidity. By mid-2026, this pattern had become visible in multiple cities. Homes sat unsold, not because they were undesirable, but because the system around them had stalled. Agents began to notice something unusual. Showings dropped, not slightly, significantly. Open houses became quieter. Week after week, online listings got views, but no action. Interest without commitment. And that's when the realization began to set in. This wasn't just a slowdown. It was a withdrawal. Buyers hadn't disappeared because they couldn't buy. They disappeared because they chose not to. And that choice, rational on an individual level, was reshaping the entire market. Because when demand becomes optional, instead of urgent, everything changes. Prices become negotiable. Timelines stretch. Confidence erodes. And most importantly, liquidity fades. But here's the deeper problem. Once buyers step away long enough, they begin to adapt. They adjust their expectations, delay their plans, find alternatives, and the longer they stay out, the harder it is to bring them back. Because re-entering the market requires something powerful. A reason, a trigger, a shift strong enough to break the cycle of waiting. And at this point, that trigger hadn't appeared, which raised a troubling question. What if buyers don't come back anytime soon? Because if they don't, this isn't just a temporary imbalance. It's a structural change. A market where liquidity isn't just reduced. It's fundamentally broken. At first, sellers were patient. They had been through slow markets before. They understood that sometimes it just takes time. So they waited. They refreshed their listings, adjusted their photos, scheduled another open house. And for a while, that felt like enough. Because hope is easy to maintain in the early stages. But time changes everything. Weeks turned into months. Mortgage payments continued. Property taxes didn't pause. Maintenance costs kept accumulating. And slowly, the cost of waiting began to rise. This is the moment most people underestimate. Because a frozen market doesn't hurt immediately. It tightens gradually until one day, waiting is no longer a strategy. It's a problem. And when enough sellers reach that point at the same time, the market shifts. Not smoothly, but suddenly. Because sellers are not all the same. Some can afford to wait. Others can't. And it's the second group that changes everything. Relocations, divorces, job losses, debt pressure, Life doesn't pause just because the market does. So these sellers make a different decision. They don't wait for the perfect offer. They take what they can get. Or more accurately, they take less than they expected. This is where the first real cracks appear. Not in headlines, not in broad market data, but in individual transactions. A home sells below asking price, then another, even lower, then a third, with significant concessions. And suddenly, comparables begin to shift. Because in real estate, every sale resets the benchmark. And once those benchmarks start moving downward, they pull everything else with them. This is how price discovery returns to a frozen market. Not gradually, but through pressure. Because liquidity doesn't come back on its own. It has to be forced. And the force comes from sellers who can't wait. But here, where it gets more complicated. Because falling prices don't immediately solve the problem. In theory, lower prices should attract buyers. But in reality, they often do the opposite. Because falling prices send a signal, not of opportunity, but of risk. Buyers see price cuts, and they don't rush in. They step back. They ask, if it's falling now, why buy today? What if it drops further? And just like that, price reductions fail to restore liquidity. Instead, they reinforce hesitation. This is the paradox of a liquidity crisis. The very thing that should fix the market can actually deepen the freeze. And as this dynamic spreads, something even more dangerous begins to form. A chain reaction. Because housing markets are interconnected. One sale affects another. One price influences the next. And when enough sellers start cutting, it doesn't stay isolated. It spreads, neighborhood by neighborhood, city by city, until what started as a few pressured transactions becomes a trend. And trends change behavior. Now even sellers who can wait start to reconsider, because they see what's happening around them. They see homes selling for less. They see listings sitting longer. They see momentum shifting. And they ask themselves a different question. What if waiting makes it worse? That question changes everything. Because once sellers begin to fear future losses, they act. They reduce prices faster, more aggressively, not because they want to, but because they feel they have to. And that accelerates the cycle. More price cuts, right arrow more uncertainty. More uncertainty, right arrow fewer buyers. Fewer buyers, right arrow even more pressure on sellers. The loop tightens, and liquidity still doesn't return, because the underlying issue hasn't been solved. Confidence. Without confidence, buyers don't step in. And without buyers, transactions don't recover. But the consequences don't stop at individual sellers. They extend into the financial system. Because real estate isn't just an asset. It's collateral. Banks lend against it. Investors build portfolios on it. Homeowners leverage it. And all of that depends on one critical assumption: that the asset can be sold. Not instantly, but reliably. When that assumption weakens, so does everything built on top of it. Lenders become cautious. They tighten standards, reduce risk, pull back. Because in a market where homes don't sell, Foreclosures become harder to resolve. Losses become harder to manage. So credit contracts. And when credit contracts, it removes even more potential buyers from the market, which further reduces liquidity. And the cycle continues. At this stage, the market isn't just frozen. It's under strain, because pressure is building from multiple directions. Sellers need to sell. Buyers don't want to buy. Lenders don't want to lend. And no one is in control. This is the tipping point. The moment where a slow-moving freeze turns into something more unstable. Because systems like this don't stay balanced for long. They either recover or they break. And recovery requires something powerful. A surge of demand, a shift in sentiment, a reason for buyers to return. But if that doesn't happen, then the alternative is unavoidable. Forced adjustment, rapid repricing, and in some cases, capitulation. The kind of environment where sellers stop asking, "What can I get?" and start asking, "What can I save?" And once that mindset takes hold, the market changes completely. Because at that point, it's no longer about maximizing value. It's about minimizing loss. And that's when liquidity finally returns. But not in a way anyone wants. Because it comes at a cost. Long after the market starts moving again. By the time liquidity returns, it doesn't feel like recovery. It feels like surrender. Because markets like this don't fix themselves gently. They reset. And resets are never evenly distributed. Some sellers get out early. They take smaller losses. They move on. Others wait too long. They hold on to old expectations. They believe the market will turn back. They delay decisions just a little longer. And by the time they act, the conditions have changed completely. Offers come in lower than expected. Negotiations become one-sided. Leverage disappears. And for the first time, sellers feel what buyers felt just a few years earlier. Pressure. But this time, there's no competition to save them. Because buyers now have control. They take their time. They negotiate harder. They walk away more easily. And slowly, transaction by transaction, liquidity begins to return. But not because confidence has been restored. Because prices have adjusted enough to force activity. This is the uncomfortable truth about liquidity crises. They don't end when people feel better. They end when the numbers make sense again. When prices fall far enough, buyers reappear. Not all at once, not with urgency, but gradually, cautiously, and with a completely different mindset. Because this time, they're not chasing the market. They're controlling it. They've seen what happens when prices disconnect from reality. They've experienced the cost of waiting and the cost of acting too soon. So they move carefully. They analyze. They negotiate. They protect themselves. And that changes the structure of the market going forward. Because once a liquidity crisis reshapes behavior, it doesn't immediately revert. The memory stays. Sellers become more realistic. Buyers become more disciplined. Lenders remain cautious. And the entire system operates differently for a while. But the effects don't stop there. Because housing markets don't exist in isolation. They connect to everything: consumer confidence, spending, mobility, investment. When homes stop selling, people stop moving. And when people stop moving, opportunities shrink. Job changes slow down. Relocations get delayed. Construction activity weakens. And the economic ripple spreads outward. Quietly, but persistently. This is why liquidity matters so much. Not just for investors, not just for homeowners, but for the system as a whole. Because liquidity is what keeps everything flowing. Without it, things don't collapse immediately. They stagnate. And stagnation is harder to fix than a crash, because it doesn't force action right away. It lingers. And in that lingering, damage accumulates. Opportunities missed. Decisions delayed. Capital locked in place. All because something that was once assumed became uncertain. The ability to sell. And once that assumption is broken, it takes time to rebuild. Because trust is not restored by price alone. It's restored by experience, by transactions happening again, by buyers and sellers meeting in the middle, by the market proving, slowly, that it works. But even then, something has changed. Because those who went through it don't forget. They remember the silence, the empty open houses, the listings that didn't move. They remember the moment they realized this might not sell. And that realization reshapes decisions for years to come. Investors become more selective. Homeowners become less aggressive. Buyers become more patient. And the cycle begins again, but differently. Because every liquidity crisis leaves behind a lesson. Not always obvious, not always immediate, but powerful. It reminds the market of something fundamental. That value is not what you list at, not what you hope for, but what someone is willing and able to pay at that moment. And when that willingness disappears, everything else must adjust. No matter how long it takes, no matter how uncomfortable it becomes. Because in the end, markets don't operate on belief. They operate on action. And when action stops, that's when the real risk begins. This wasn't just a story about falling prices. It was a story about disappearing liquidity. About what happens when buyers step back and sellers can't move forward. About a system built on constant motion, suddenly standing still. We saw how it began quietly, with hesitation, with small delays. We saw how it deepened, as buyers opted out, as investors pulled back, as expectations diverged. We saw how pressure built, as sellers were forced to act, as prices adjusted, as confidence weakened. And finally, we saw how it ended, not with a dramatic crash, but with a slow, uneven reset, where liquidity returned, but only after the market redefined itself. And those who understood this shift early, who adapted quickly, who recognized that the rules had changed, they weren't just participants in the market. They were ahead of it, untouched by the worst of the disruption, positioned, while others were reacting. Because in a liquidity crisis, the most powerful position isn't ownership. It's flexibility. The ability to wait, to move, to act when others can't. And those who had it walked through the freeze, untouched.